For decades, the world of investing was dominated by a simple belief: active management reigned supreme. The idea was that skilled fund managers with their deep knowledge and access to vast resources could consistently beat the market by picking the right stocks at the right time. Did you know that this statement is one of the biggest scams in investment circles? Fund managers, armed with research and complex strategies, promised to pick winning stocks and outperform the market. They spent countless hours analyzing financial statements, meeting with company executives, and using sophisticated models to predict future stock movements. S&P Global's SPIVA, S&P Indices versus Active Scorecard, consistently demonstrates that a majority of active fund managers underperform their benchmark indices over the long term. For example, over longer periods, such as 15 or 20 years, the vast majority of active funds fail to beat their relevant indexes. This consistency across various market conditions is very telling. Specifically, the SPIVA reports show that over longer time periods, like 15 years, it is very rare to find any category of domestic or international equities where the majority of active managers outperform. The impact of fees and survivorship bias. Active management involves higher fees, which significantly erode returns over time. Index funds, with their lower expense ratios, retain more of the market's gains. Furthermore, survivorship bias skews perceptions. Poorly performing active funds often get closed or merged, removing them from performance records. This creates an artificially positive view of active management success. The SPIVA reports account for this, providing a more accurate picture. The fact that a large percentage of active funds cease to exist over longer time periods is a very important factor to consider. Index funds, which simply tracked a specific market index, began to emerge as a formidable alternative. These funds didn't rely on the expertise of fund managers, but instead aimed to replicate the performance of the market as a whole. This passive approach to investing, once dismissed by many, has consistently demonstrated an ability to match or even surpass the returns of actively managed funds. By minimizing costs and avoiding the pitfalls of market timing, index funds have proven their worth. The rise of the index fund is a testament to the power of simplicity and diversification in investing. By spreading investments across a broad range of assets, these funds reduce risk and enhance potential returns. As we delve deeper into the world of index funds, we'll uncover the reasons behind their success and how they can empower you on your journey to financial freedom. Understanding the principles behind index investing can provide you with the tools to make informed decisions and achieve your financial goals. In the simplest terms, an index fund is like a basket of stocks that mirrors a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Instead of trying to pick individual winners like actively managed funds, index funds hold all the stocks within the chosen index in the same proportions. This straightforward approach offers investors a diversified stake in the overall market. Imagine owning a small piece of every company in the S&P 500. That's essentially what you're doing with an S&P 500 index fund. As the overall value of these companies grows, so too does the value of your investment. Index funds are designed to match the performance of their corresponding market index with lower fees than active management. They achieve this by passively holding the same securities in the same proportions as the index. For example, if Apple makes up 5% of the S&P 500 index, an S&P 500 index fund will also hold approximately 5% of its assets in Apple stock. This mirroring effect means that when the market index goes up, the index fund generally rises as well. Conversely, if the market index declines, the index fund will likely experience a similar drop. One of the fundamental principles of investing is diversification, which means spreading your investments across different asset classes, industries, and geographies. Index funds inherently embrace diversification by holding a broad range of stocks. This built-in diversification helps to mitigate risk. If one company or sector performs poorly, its impact on your overall portfolio is cushioned by the performance of the other holdings within the index fund. The index fund advantage: lower costs, higher returns. Index funds boast several key advantages over actively managed funds, primarily lower costs and the potential for higher long-term returns. Because index funds are passively managed, they have significantly lower expense ratios, which are annual fees charged to investors to cover the fund's operating costs. Over time, these lower fees can translate into significant savings and enhanced returns. Furthermore, studies have consistently shown that index funds tend to outperform actively managed funds over the long term. This is partly due to the lower fees associated with index funds, but also because it's incredibly difficult for even the most skilled fund managers to consistently beat the market. Exploring index fund options. Finding the right fit for you. When it comes to investing, one size does not fit all. Each investor has unique goals, risk tolerances, and time horizons. Therefore, it's crucial to find the right index fund that aligns with your individual needs and preferences. Index funds come in various flavors to cater to different investment goals and risk tolerances. Whether you're a conservative investor looking for stability or an aggressive investor seeking high returns, there's likely an index fund that fits your profile. Some of the most common types include market cap weighted index funds, sector-specific index funds, and international index funds. Each type offers unique benefits and caters to different investment strategies. Market cap weighted index funds. These funds weight their holdings based on the market capitalization or total value of outstanding shares of each company in the index. This means that larger companies have a greater influence on the fund's performance, making it a popular choice for those who believe in the stability and growth potential of large cap stocks. Larger companies have a greater influence on the fund's performance. This type of fund is ideal for investors who prefer to invest in well-established companies with a proven track record. Sector-specific index funds. These funds focus on a particular industry or sector, such as technology, healthcare, or energy. They offer more targeted exposure for investors seeking to align their portfolio with specific market segments. For instance, if you believe that the technology sector will outperform the market, you might choose a technology-focused index fund. They offer more targeted exposure for investors seeking to align their portfolio with specific market segments. This allows for a more customized investment approach, catering to your specific market outlook and investment thesis. International index funds. These funds track indexes composed of companies based outside of the investor's home country. They provide geographic diversification and exposure to global growth opportunities. Investing in international index funds can be a great way to tap into the economic potential of emerging markets and developed economies alike. International index funds provide geographic diversification and exposure to global growth opportunities. By including these funds in your portfolio, you can mitigate the risks associated with investing in a single country and take advantage of growth opportunities worldwide. Choosing your index fund, aligning with your goals. Selecting the right index fund depends on your individual investment goals, risk tolerance, and time horizon. Consider the following factors. Investment goals. Are you saving for retirement, a down payment on a house, or your child's education? Your investment goals will influence the time horizon and level of risk you're comfortable with. Risk tolerance. How much volatility are you willing to stomach in your investments? Index funds. Tracking broader market indexes tend to be less volatile than sector-specific or international funds. Time horizon. If you have a longer time horizon, you may be able to tolerate more risk and potentially benefit from higher returns over time. Building a solid portfolio. Index funds as building blocks. Index funds serve as excellent building blocks for a well-diversified investment portfolio. They offer a simple, cost-effective way to gain exposure to a broad range of assets, making them ideal for both novice and experienced investors. Here are some key principles to keep in mind when incorporating index funds into your investment strategy. Start small and be consistent. You don't need a large sum of money to begin investing in index funds. Even small, regular investments can grow significantly over time due to the power of compounding. Start with what you can afford and make regular contributions over time. Consistency is key, and setting up automatic contributions can help you stay disciplined. Dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. By doing so, you buy more shares when prices are low and fewer shares when prices are high. Dollar cost averaging helps to reduce the impact of market volatility on your investments. It smooths out the purchase price over time, potentially lowering your overall cost per share. Rebalancing. Over time, the value of your investments will fluctuate, causing your portfolio to drift from its target asset allocation. Regular rebalancing ensures that your portfolio remains aligned with your risk tolerance and investment goals. Rebalancing involves selling a portion of your holdings in overperforming assets and reinvesting those proceeds into underperforming assets to maintain your desired asset mix. This disciplined approach helps manage risk and can enhance long-term returns. Weathering the storm index funds in economic downturns. Economic recessions and market downturns are an inevitable part of the investment cycle. During these periods of uncertainty, index funds have historically demonstrated resilience. While their value may decline in the short term, their diversified nature helps to mitigate losses and positions them for recovery when the market rebounds. As Warren Buffett, the legendary investor, once said, "The best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table." Index funds allow you to do just that. Buy into a diversified basket of companies at potentially discounted prices during market downturns, setting the stage for potential long-term growth.